here at the Real Estate Roundtable with IPRG, and today we have another guest, Seth Weissman, who is the founder and president of Urban Standard Capital. So, welcome.
Thanks for having me. You have beautiful offices. It's great to finally see them.
Thank you.
Yeah, for sure. We're really happy you're here, and we were doing some research on you before the show, but I mean, it seems like you've done it all in real estate. So, really excited for the conversation.
Well, lots to talk about. It's an interesting time in the market.
For sure.
Yeah. All right, so this conversation got started because after one of our financing episodes, you sent me and Jason Au an email, and you said that you're seeing a lot of demand for bridge to bridge and for the pref mezz slices, I guess, of what you offer.
Yeah.
And Jason replied and said the issue with pref mezz loans is the community banks won't allow it, and you said some will, however, a lot of them aren't going to have much of a choice. You said you think they'd be better off effectively having two layers of borrowers than having to sell their paper at discounts. So I thought that could be a good place for us to start. Some of these terms, honestly, I don't know if I can fully define them or if our listeners could. Bridge to bridge, I think this is the first time I've heard that. Pref mezz slices. You know, look, I mean, in investment sales, which is what we do,
Yeah.
we don't come across this stuff often. So I'd love for you to, explain just what you mean in terms of they're not going to have a choice and two layers of borrowers.
Sure. So I think the general shift in the market that we've seen over the last 6 to 9 months, right, has really been driven by what's happening in the capital markets, right? And so if you go from an environment where interest rates are, in the mid 3s or 4% range to the mid 6s from bank financing, that really limits your purchasing power as a buyer, right? And if you're refinancing and you bought an asset 3 to 5 years ago, even putting aside the rent law changes, right, which were devastating on a lot of levels, and you had an NOI that was $200,000 a year on a stabilized product, and there wasn't much of a value add business plan, and you sized that loan off of a 3.5% rate. Fast forward 3 years, 5 years, your NOI probably hasn't moved that much. Maybe it's down given where expenses have been, and your lenders are looking at sizing your loan today based off of a higher interest rate and higher debt yield. So you're probably short every bit of 30% of the proceeds that you previously had. So the question becomes, do you sell your asset? Do you pony up the additional equity? Because if the bank is saying, we had lent you, $2.5 million, and now we'll only size a loan for $2 million or $1.75, you've got to write that check. And you can either write that check, you can go to your LPs and write that check, you can talk to you guys and sell the asset, or you could go to either your LPs or another private source of capital and say, we're going to have bank financing at $1,750,000. I need $750,000 to replace that gap between the $2.5 million I had and what I have today, and that gap can either be filled as preferred equity, which just means it's senior to the common equity. It has typically a coupon on it, and that money gets paid everything after the senior has been paid, right? And so, senior, the bank gets paid first, the pref gets paid next, and then whatever is left over goes to the common equity.
That's in a sale.
That's in a bringing in like preferred equity from me. Somebody comes to me and says, "Will you write this check to fill that $750,000 shortfall?" Certainly, they may say, "I don't have the access to write it, and maybe I want to hire you guys to sell it, and the new person coming in is just going to capitalize it differently. Maybe they're going to say, you know what, that asset was worth $4 million, right? I'm going to buy it now for 3.5. I'm going to get a loan from the bank for $2 million, and they're going to have to put in that $1.5 million. And the person who's selling might be taking a little bit of a loss, but they're moving on. They don't have to put more money into the deal, right? So hiring, a group like yours that knows the market inside and out, knows who's active, right? That's definitely an option for them. But if they think this is a moment in time, I like the long-term prospects for this property and for these cash flows, maybe they don't want to sell immediately, going to a group like Urban Standard that could write that pref piece, right?
So that's pref.
That's pref.
Real quick on the pref piece, do they have to pay to borrow? Is it borrowing the pref? I don't know if that's the right term, but do they have to pay monthly towards the pref the way they would on a loan?
So you can do it that way. We've done it where, we'll size a reserve. The rate on that kind of stuff tends to be in the sort of 12 to 16% range.
On pref equity?
Yeah.
Okay.
So like we might say, all right, half is paid current, half accrues. We'll, out of the $750,000 check, and we wouldn't probably do something less than like $2-3 million, but just to keep this sort of story going. We're going to hold back, 15% from the 750, right? So you're actually only going to get maybe 650 or so, and pay it out of a reserve like you would in a loan.
Okay.
And then depending on the term, the pref can have a term like a loan can. It could be a year, 2 years, whatever. It can be redeemed. So if in a year they come into money or the market's changed, they want to refinance, like they can then pay us off, right? But to answer your question, it can be paid current, it can accrue, it can be a combination of the two.
Okay, and so
But I'm getting all the cash flow in that interim.
And also, the LPs don't have to throw good money after bad here, right? This is you taking that position, and then you're getting paid back at a later date, so they can keep the property, and they don't have to go to investors and have that paid down.
Correct, right?
Which is a great option.
Which is an option.
Yeah.
We're doing a deal now where, that particular borrower, and the theme is similar, right? They've crushed it on rents. Rents are really strong, which is great, but not enough to make up for just the very unexpected, very sudden and sharp rise in rates, right?
Yeah.
And also banks are really pulling back. So, they have a couple $1 million shortfall. Their LPs are just going to write the check, right? They don't want to borrow, at 15 or 16 or 17% or whatever it is. They have that option. If you don't have that option, or even if you do and you sort of want to hedge your bet, maybe you say, my gap is $3 million. We'll put in $1.5 million. Urban Standard puts in the other $1.5 million, right? Like you sort of figure out what your comfort is.
Yeah.
And it really depends on your outlook for the market, your outlook for the building in particular, your personal sort of risk tolerance and liquidity. I mean, it's as much, frankly, an emotional decision at times as it is a financial and rational one. But it's a solution, right? And the difference between pref and mezz, they sit in the similar parts of the capital stack in that they're senior to the common equity, but they're subordinate to the bank loan.
Okay.
It's more of a difference in what the security is. So like a mezzanine is a type of like lien, and then the agreement you need to have with the senior lender. It's called an intercreditor agreement if it's a mezz loan, and it's a recognition agreement if it's a preferred equity.
So preferred equity, you're basically taking on another equity partner, in essence, that has a senior position.
100%.
And does that have anything to do with the original bank? Meaning, would they have to sign off on this, or is it just taking on a new partner in a way? Where the mezz, you said you have to get signed off on, right?
Yeah, I mean, you can do it without the permission of the senior lender. It's almost certainly a default under the loan.
Got it.
So
If they find out.
If they find out,
Okay.
right? So most people don't do it that way. We want the senior lender to know, because if the underlying borrower defaults, we need certain rights to cure the default, right? We want to be able to step in, make payments, buy the loan from the senior, so that we're not, because if the senior loan has a coupon of 8% and default, or 7%, and the default rate in New York statutory is 24, I don't want them going into default ahead of me and then pushing my position back, right? And because not only is the principal of the senior loan senior to my piece, the accrued interest is too.
Okay.
So I require, right, in that agreement with the bank to say, if there's an underlying default, you have to give me cure periods. I have the right to buy your loan at par. You cannot sell it to anybody else, all to protect my position. If you're the senior lender, you shouldn't really care because to the comment about double borrowers, now your primary borrower defaults, you're going to look to me, and I either have to keep you current or I have to buy your loan at par. So
When
that's
you say par, you're at the price of the loan.
at the price of the loan.
So if it's 3.5
Whatever.
loan, you have to pay 3.5. So they're not
Exactly.
getting a discount
Or
on the
whatever it
debt.
amortizes to.
Right, exactly.
But you can still negotiate to get a discount on the debt, right? If you want to. If you
I
think the guy's
I
in
could. I think
space.
it depends, like what my position would be, right? But generally, I'm not asking for that. I'm just asking to my right is to buy it at par, right? And if you're a bank, that's a pretty good position.
And they have zero issue with that. Why would they?
It's I think in the regional bank market, it's not the same level of sophistication as I would say there is more among the national banks that maybe do this on larger size loans. I mean, we really sort of play in the middle market space, which for us is 50 million and less, right? And a lot of the assets where the loans are under 10 million or either under 5, a lot of banks don't. There's a sophistication element of it, but there's also just I don't want to be bothered.
Keep it simple.
Keep it simple. I will lend you this money. This is my debt service coverage. This is my yield. A layer of pref or mezz for $1 million. Now they have to have an intercreditor. It's noise and it's brain damage that a lot of lenders don't want to deal with.
And you mentioned you try to keep it above 2.5 for pref debt.
Yeah.
Is there a market? Because we're going to start seeing this a lot, I think, in our neck of the woods, where there's 6 families and 8 families where there's definitely a gap, and they're going to have to either get money from their LP or sell. But is there someone that's going to give $500,000 pref, or is that not really a market?
I think there's more of an individual market for that.
Okay, gotcha.
I mean, we would look at it probably more in a portfolio.
Okay.
The challenges are that the cost of sort of papering it.
Yeah.
Right, and all of a sudden it's all right, I'm gonna go spend $30,000, bank legal, but two borrower legal, pref or mezz lenders legal, senior bank legal. All of a sudden you're like, that could easily be a $30,000 legal bill between the groups, and you're talking about a $500,000
Yeah.
position. So there starts to be real friction costs. I think more what I see in that position is a sponsor or borrower will go to their LPs. Not every LP, they have 10 LPs that are each, $250,000 or $100,000 or whatever it is. Not everyone's going to want to contribute for a variety of reasons. They may not have the liquidity. They may say, the New York market or whatever. Everyone has their own thing, but you might have 2 LPs who step up and say, I'll advance those funds.
Dilute the rest.
I'll dilute the rest, or I want a priority over the return of the rest. And those LPs might say, that's fine.
Yeah.
I don't want to put additional money in, and they don't know.
I think if it's a good deal, an LP's gonna have no problem doing that. Obviously, these people have money. That's why they're in these positions. But my concern was if it's like a 6 family in Bushwick where rent stabilized laws really hurt it, are they gonna go in and throw more money at this asset where they think is a loser at this point?
They may not.
Yeah.
And I think you start to see defaults,
Yeah.
especially in the stuff where there was a rent regulated component. I think those assets, even pre-COVID, pre-rate change, were questionably underwater.
For sure.
And with not a really a clear sight toward resolution, right? I mean, I think politically you're starting to see some wind shift. I think people are realizing we have a real problem here. They're putting aside the crime and the homelessness and the other issues, but I think 421A, total debacle. Amazon, total debacle.
Yeah.
Right? There's 50,000 vacant apartments that can't be renovated because of the law changes on how to set rents. That's a total debacle. So I think the mayor, at least he's saying the right things in terms of recognizing you need to incentivize the private markets appropriately because capital is mobile. Capital will go to other markets as we've seen a flood of money leave New York. And the unfortunate result for New York City is that there's a supply crisis, right? And that's only going to get worse as more and more units sit unable to be renovated or 420. And we financed a lot of 421A buildings. You don't see it anymore, right? Because not only is that program gone, but all the legacy sites that were grandfathered in, they have to be completed by, I think it's 2026. And that's just, now you're just the time period is too tight. So that market's frozen too.
Real quick, getting back to this whole like 2 layers of borrowers thing. So if there's like a community bank that's giving the initial loan, they have their debt service coverage ratio requirements. And now if you throw in like either the pref or the mezz at 15% or 12%, those aren't going to cover for debt service coverage ratio. Your ratio will be at like 1.0 or maybe less.
Yeah.
So how does that work with the underlying lender,
Sure.
senior loan?
So remember, they have priority, right? So in that example of the $4 million building that had a $200,000 NOI, right? That it was at a 5 cap before, right? Now you're, first of all, in a refinance, you're paying that lender down, right? So that $750,000 or whatever is reducing their debt service. So the amount needed, it's reducing the loan amount, right? So the amount needed to service that debt is dropping because more equity has come in. Now, that equity, if it's from me or if it's from an LP who's advancing his pref, it has a return on it, but 15%, but it's subordinate to the return of the bank, right? So the bank is now saying, all right, my loan went from $2.5 million to 1.75 times the rate, right? And what is the cash flow? The NOI may still be the same 200,000, right? But so they're still maintaining their coverage.
But when the interest rate goes from 3.5 to 6.5, then all of a sudden the coverage is much more expensive. So
right, which is why they're requiring the pay down.
Correct.
Right.
Requiring the pay down. But now you have all this extra cash flow that's going to service the pref or the mezz.
Yeah.
So does the bank even look at that, or they just don't care?
They will look at it, but again, that no cash flow is going to the mezz or the pref until the senior gets paid in full, right?
Okay.
And so I think it's something that most banks are aware of, but it's a little more like it doesn't matter as much because, before I get to get any part of that $200,000 example, right, the bank's getting 100% of that money.
Yeah.
Right. So it's like, yeah, if there's excess, if the new debt service is, $150,000 a year, and there's $50,000 left over that can go to me as the pref, I only get that once the bank has gotten 100% of their money.
Got it.
Right. So it sort of shifts, and that's sort of the double layer of borrowers, right?
Yeah.
There's now me, and then there's the end borrower who want to make sure that loan is current, right?
Yeah.
And so that's another layer of protection, which I think you're gonna, it's going to become more of an attractive option for banks because the alternative is
What's the alternative?
the alternative is a loan default, right? And you've got
So what happens then? It goes into foreclosure? Or
Yeah.
it just goes into default?
goes into default. You can trigger default interest.
Yeah.
You start the foreclosure process.
Yeah.
If somebody has guarantees, it's a problem.
Yeah.
For the guarantor.
Yep.
Right, and borrowers, of course, want to avoid that, right?
Yeah.
But so do banks, because banks,
sure.
are having regular regulatory review. They have certain capital reserve requirements that they have to maintain, and if they don't, they have to hold back greater reserves. Like if they have high defaults in their portfolio, they can't lend as much, and it hurts their earnings power, right? So they're very sensitive to that, which is why I think, a couple of the lenders I've spoken with that are regional balance sheet lenders are looking at their pending maturities over the next 12, 24 months and are saying, well, what's the current NOI? What's the trailing 12 look like? If we had to refinance today, what would the proceeds be?
Yeah.
And they're getting in front of all their borrower relationships, and they're saying well, what's the plan?
Yeah.
Right. Even if we have a couple buildings that are maturing in June or July of next year.
These are ones that you lent on or you own?
That I own on the
Okay.
equity side
Yeah.
of our business. And, we went through the portfolio. We don't have significant leverage on them, but looked at our NOI, and we're saying to ourselves, well, what are our options, right, to really also making sure we're maximizing NOI, because, banks are going to look back at that and, the seasoning over the last, T12, are there, under market leases we want to bring to market? Are there, commercial? We have a building, one of the buildings in Bedside where we have a tenant that's lease expires next summer. We went to them in advance. We knew they wanted a renewal for 10 years. We raised the rent. They were under market, but we brought the rent up 50%, right? And gave them a 10-year renewal. Why did we do that? we wanted to lock in that additional rent roll and NOI in advance of our loan maturity, right? Because it was a couple $1,000s a month, so 24, 30,000 a year. Even on today's cap rates, right? That's a $500,000 swing
For sure.
in value. And if you're the bank looking at that, it just gives you another cushion. So we've really gone through the portfolio. We don't have a lot of loans maturing in the next 12 months, but making sure we're getting in front of it. And that bank, understandably, first of all, the fact that they're asking the question this far in advance is telling, right? Because they're, I'm sure, looking at their portfolio and trying to get in front of issues. So people are trying to harvest whatever income they can.
Yeah, it's a good point. I mean, we're getting a lot of calls from people where they want to know the values. They're trying to figure out what they're sitting on, where's the market at, what are they going to do, and a lot of these are loans. I mean, we're seeing this a lot on the 2018 loans at this point. I don't know what's going to happen when those come due, if they're going to go into option. A lot of these guys say they can go into option or come up with some kind of workout with the lender. I have no idea how that's going to play out. I guess we'll see.
Yeah.
But yeah, I mean, I guess I just want to go through a couple other terms, and then I want to talk about urban standard.
Sure.
But you said bridge to bridge. I don't know what that means. I saw on your website there's a lot of talk about construction loans, acquisition loans, condo inventory loans. So I'm just trying to understand how all this stuff kind of plays out.
Yeah, sure.
Yeah, all the products.
So we have 4 buckets of capital. We manage money on behalf of institutions, pension funds, insurance companies, family offices, foundations, ultra high net worth individuals, and everybody has within those groups, they have their sort of risk tolerance and return tolerance, right? And it runs the spectrum from but I'll explain it shortly, like an inventory loan where the building has been built, construction's complete, you're paying off the construction lender, you're just financing the sales, right? So it's a lower risk loan than a ground up project that's in the early innings. Part of my job as I develop the 4 strategies that we have, which is core plus debt, value add debt. The core plus debt would be like an existing, there might be some moderate renovations or repositioning, but it's pretty much stabilized. Value add would be something where there's heavier repositioning or construction. And then the second position strategies, which are the mezz and the pref loans that we talked about. So those are sort of the 4 buckets.
Those are the buckets under the lending aspect?
Under the credit strategy for our fund.
Got it.
Part of my job is making sure that those products meet the demand of the market, right? And at the moment, we are seeing a lot of demand for the mezz and pref slices and some of the more value add debt, because we're really seeing demand, frankly, for all 4, because a lot of banks have just pulled out of the market completely.
Yeah.
But part of my role is making sure that what we have on offer to the developers and operators in the market, also meets the demands of what the capital markets is looking for, right? Yeah. So when I'm talking to insurance companies and pension funds, it's what are their return targets? What are they trying to solve for? How do they think about risk? And Urban Standard Capital sort of serves in the middle, right? We have committed discretionary capital, but I need to marry the real estate needs with the investment management needs, right? Because we're part of the sort of ecosystem of investment options, right? If you're an insurance company, you can go buy, AAA securities and corporate bond. You can buy any kind of security, right? Instrument, right? You don't have to just make real estate loans. So you're competing against other investment instruments, and it's a dialogue about what some offer, what some don't, and
so you're basically, you find a need. Someone comes to you and says, Seth, I need X amount of money for this. Then you go to your capital stacks and you say, this is good for you, this is good for you, and you pitch it to them, and then you just make like a marriage?
So we have committed discretionary capital. So our model is set up as a private equity fund.
Okay.
And that's really important because if we have a client that needs to close, I'm not going to raise the money. I have the money already.
Correct.
Right? So I can provide speed and certainty of execution to those borrowers. But I'm constantly talking. I probably spend half my time talking to investors and understanding what their needs are in the marketplace, right, and what they're looking for. And it helps me as I'm looking at different deals, like where do we want to raise additional capital under a certain strategy, and what the sort of appetite is, right? But yeah, we're set up as a fund that has, a balance sheet.
Are you getting like a little ahead of the curve on this condo inventory refinances? Because I'm starting to see those in the news a little bit. Like I saw this morning that Gary Barnett just did a huge one for 300 units that he couldn't sell. And I haven't seen it before.
Yeah.
You mentioned it today, and then I saw that this morning, I think.
Now you're going to see it everywhere.
Yeah, and I
Just
feel like
because you're conscious of it.
well, it makes sense.
It's like one of those things when you talk about it and it's
Yeah. Well, interest rates are going up. Buying a home is going to be more difficult, so it makes sense that they're going to have units that can't be sold.
Right, exactly. Absorption has slowed.
Yeah.
Right. This is what we saw. Big demand for this in the early innings of COVID. Mm-hmm. People weren't buying, so all of a sudden, projects that were on the market just sat. Right. You're seeing that challenge now because all of a sudden people are like shell shocked about how much it costs, and there's strategies developers are employing to, sort of reduce how expensive it is for the end buyer. But yeah, so you're seeing demand for condo inventory loans. Something we've done a lot of, and again, it just pays off your construction lender, and it gives the developer runway to have their units sold and for those units to be absorbed. That's a trend I think we're going to see. Of course, we're seeing across the board, demand for capital just because the capital, like the banks have really pulled back. A lot of groups, in the private lending space, I sort of always joke that there's a lot of companies that have the word capital in their name and their logo, but they don't actually have any capital, right? They've got to go and
true.
they've got to pass the hat around.
There's brokers that call themselves capital.
Yeah, we have no capital.
Right.
We do.
You know what I'm saying? It's like a silly thing, but
Yeah.
I two instances in the last week where we lost deals and they just both came back to us because they went with lenders that didn't have money. I could have told them they didn't have money.
Wow.
And I get it. Like raising discretionary committed capital is very hard to do, right? When I started my business, it was doing deal by deal syndications, and you sort of need to do that because you need to demonstrate you have a track record, right? This is the strategy. Going to there's no walking into that insurance company's office or family, office and saying, write me a blind check, right? Like, you sort of have to demonstrate. And so, I get why people do it. But if you are a borrower, and we just had this, I'm not going to name the name of the borrower because you guys know him well, but, we had a borrower and their bank, like 6 weeks into the loan process, just said, we're credit committee, the secretive credit committee that, whoever that is, has decided we're not making any loans, through the first quarter of next year.
Crazy.
Well, great for our client who has a 7-figure deposit, like on a property, and you've just dragged him along for 45 days, and now he's got to scramble. We've done a lot of loan, so we're getting a lot of calls on deals that really would have been bank financing 6-9 months ago, right? But they're now paying 300 basis points more in rate, right? But it's a shorter duration. It's sort of like it's better than losing your deposit, right? And you execute your plan and then you refinance with the conventional markets. But if you go to a lender, that can't provide that certainty, whether it's a bank or it's a capital private lender that doesn't have any money, that's a huge risk, and people are willing to pay up for certainty.
We're getting those calls. We're a lot, but there's so many people. It's very easy to tell someone, hey, I'm starting this fund. I have money. Like, send me your clients.
Yeah.
And then obviously you do it, and the brake lights hit because they're going to go syndicate that money. And that's not a position you want your clients to be in. So, that's just an excellent point. I think a lot of people were doing that.
Most people do that.
Yeah.
Sure. Especially in the middle market
Yeah.
space.
Oh, yeah.
And like, listen, I just, behind the scenes, right? Like our rates are definitely, we don't compete on rate, right? Our rates are 100 basis points, probably 150 basis points higher than, some other groups. But if that group doesn't have the money, like, what's the matter?
It's irrelevant.
Right? And I always say to, our clients, listen, you make the decision about what's best for you, right? You're, a successful entrepreneur, what have you, like, I need to price this because I need to deliver the returns to my investor. So I have committed discretionary capital because we outperform our peers. One of the reasons we outperform our peers is because we get paid more by providing that speed and certainty of execution. I'm sure you guys with your clients have had similar situations where you have two offers. One guy might be at $1 million or $1.5 million, and the seller wants $1.7 million, and they have $1.6 million from somebody who doesn't have the money. Like, there's a decision to make. Do you take the bird in hand, right, at the lower price, or do you roll the dice? I can't make that decision for you. I'm of the take the bird in hand and like lock it in, especially if you can get the delta down to under 10%. You see that all the time.
Tons.
Right. And when I started, part of the reason I went to raise discretionary committed capital is because I was passing the hat around. Right.
Yeah.
And listen, New York, there's a lot of people with real money. Right. And so, I said to my investors, I'm at a significant disadvantage by not having discretionary committed capital because I don't have credibility, right? If I'm going to a seller, it's one thing to be able to say, I can close in 2 weeks. This is my proof of funds. It's another thing to say, do you mind giving me, 30 days, 60 days while I like dance around and try
6 days on or about,
Yeah.
not a TOA.
Yeah. Well, I go like, I think, you get better pricing, you get better terms if you have the money. Right. And so that's why I raise discretionary committed capital, because whether you're a borrower or you're a seller, that's really valuable.
So as a lender, how do you weed out like your competitors, quote unquote, that are promising the world and not delivering? How do you weed them out? Do you like show proof of funds like you're a buyer, or do you get them on the phone with like your investors, be like, no, we have the 10 mil, we'll close on this?
So, at this point, I think we sort of have more of a reputation of being the certainty bid in the market, right?
Sure.
So it's a little less of an issue today than it was. But yeah, I just, I picked up a site as part of a development assemblage we're doing in Tribeca, and I forgot what we paid, like $3.5 or $4 million or something. I sent them a bank statement that had, $5 million in it, right? Like, because that was very important to that seller.
Yeah. How long did it take you to close on that one?
I don't know, 2 weeks.
Yeah.
Yeah.
You can't get quicker than that.
So you're just closing quick. I heard about you closing loans in like a matter of days.
Yeah.
That's something that the company seems to really pride itself on is quick turnaround in terms of quotes.
Yeah, it sounds sort of obvious, right? But we're sort of in the business of doing what we say we're going to do, right? We do not issue term sheets and we just send them out there because, it's a small world, right? People know each other. And if you get a reputation for doing that, right? Brokers know, sellers often know, their counsel know, people talk, as they should, right? And so, if you have a client again, right? And you're like, Seth's the bidder at $1.5 million, right? We bought a building from you guys on Hancock Street,
475, right?
Right?
473.
I think we paid $1 million.
We can bleep that out if you guys.
Yeah.
Yeah, maybe, I don't know.
Yeah.
Further, I guess it's technically public record.
Yeah.
But my point is like our bid was $1.4 million. We didn't finance it. We just closed. That was it.
Yeah.
I don't know whether you guys had higher offers or not, but if you did, there's sort of a question of do we do that? Do we roll the dice for that last 5-10%? Maybe you do, maybe you don't.
We sold the deal to you uptown too, I think.
In Harlem.
In Harlem, and you were really easy.
I'm
Set
friends
a
with.
price and it was done.
Yeah, that was it. I'm very.
I think it was a
Played
third-
chess with him.
And I still play chess with the guy. Yeah, Robert.
Right.
He became my chess teacher over COVID.
Robert Moore.
I think we've talked about
Robert.
this, I think, on some other episodes, but the certainty, especially in today's market, you need it. Things are changing
And there's
on
a
a
lot of
bi-weekly time, and for you to just, take someone because they can say something and not back it up, it can really mess up the deal.
That's a big discussion point amongst brokers
Yeah.
today. That's all we talk. We're obviously friends with a lot of the
Yeah.
people in the industry. It's all we talk about are buyers that say they're gonna do a deal and they don't do it, or they send in a contract
take a
for
contract and
for
don't
30
sign it.
days, or they change the price in hour 11. So that's happening a ton.
Right. And so, it's to our benefit, right? If, as lender, if we're a little more expensive or our proceeds are a little less or whatever, maybe we're just as competitive, but on the margin, certainly we're going to win those deals every time, because what happens if that lender doesn't show up, if that credit committee, I'm the credit committee, right? So I don't, we talk about it. We have an investment team of 6 people. We talk through everything, but I ultimately have full discretion. And I think that's comforting to a lot of people who, need to know that their partner's going to be there. And the way we've sort of tried to position the company is really as a sort of collaborative, reliable capital partner. We really sort of think about the business more as a talent manager than anything else. So we're trying to identify, by asset type, by geography, who are the top operators and developers which to me is defined as, who's active, who's good at executing, who's trustworthy and honest, like, frankly, who's pleasant to deal with, right? Because you're in bed with these people, right?
Sure.
And so, and you're in bed, for better or worse, worse, like COVID hits, and like, you got to sit down and talk with people. So, that philosophy and trying to be a reliable long-term capital partner has been really good for us. I mean, it's resulted in the majority of our business being repeat clients or, referrals. We get a lot of, service professionals who are like, they want these deals to close. Mm-hmm. We're not predatory in nature, right? We're not looking. There's a lot of, I joke sometimes, like, one of the things about the private lending space is you feel like you need to take a shower after you leave the room with like a lot of people in the industry.
Yeah.
Right. And they don't have your best interest. We're fiduciaries. We're, making senior loans for the most part, but we want you to be successful. It's a little bit like my personality. It's the personality of the company, the ethos of people in our company. Like, we love, the success of other people. We like to be a part of that, and we want to. But part of that is also we want to be doing a lot of deals with them. I mean, we have mutual clients we've done 10, 15 plus deals with, right? So when I get the phone call that I need to close next week, and we've done a deal with the person before, it's easy, right? And we get it done. It helps them, and it furthers our relationship.
Yeah. That's from the outside looking in, that's a big piece for you guys. I mean, you're a public figure in the market. People know who you are. You have a real company. And a lot of these people that give these loans, like, can you Google them? I don't know. Like, how do you know? You don't have,
for sure.
There's a lot of that. And with you, like, everyone knows who you are. I can Google you. You have a reputation. You
don't want to end up going with some predatory lender that's just going to throw you into default and foreclose on you.
No.
And it exists. And
loan-to-own stuff.
There's a lot of loan-to-own lenders. There's a lot of lenders who sell their paper immediately,
which scares the hell out of me.
As it should. And then you run into. I mean, listen, a business plan on Excel, a pro forma, that's all it is. It's an estimate, right? And like, you need somebody who can sort of zig and zag with you for better or worse, right? I mean, we upsize loans all the time. If like somebody's, the rents are ahead of where they thought they were going to be, they got, they were able to reposition a building, they bought a tenant, whatever it is, right? Like, it's an ongoing dialogue, and we asset manage all our loans in house for that reason. And you have somebody who is looking for a technical default, which you'll always find.
Yeah,
right.
For sure.
Or you're like somebody who's just selling their paper and taking the origination fee. Well, that's not a great position to be in, right? And so that's just not how we position the business.
Yeah. I want to go back to Core Plus real quick.
Yeah.
I don't feel like I fully understand what Core Plus means. In my head before this conversation, I thought it meant like very good locations. I mean, you're doing stuff in Manhattan. You have an active business in the Hamptons. You have a lot going on in what seems like great parts of Florida. We saw the recent deal outside of Vail.
Palm Beach.
What's that?
Palm Beach.
Yeah, Palm Beach.
That was a big deal.
Yeah, a lot of stuff in Florida.
Yeah.
There's something in Dallas. So in my head, I thought Core Plus was referring to the location.
Those are all good locations.
That's what I thought.
100%, that's what we thought.
I mean, the Hamptons.
I only go to
bad
places like,
locations,
people are like, do you only lend in places you guys go on vacation to? I'm like, I was going to say no. And then I was like, well,
it's kind of true.
Sort of true. There's some truth to that.
Yeah.
Core Plus more means, I mean, it definitely speaks to like a quality location, of which
Okay.
I think all those would check the box.
Yeah.
But it's mostly assets that are largely stabilized in nature. And I don't mean like stabilized, like rent stabilized. I just mean like, it's complete, right? So, we did a loan for GDG on 100 Franklin, completed condo in Tribeca. They had sold a bunch of units successfully, a beautiful project. They do wonderful work. And yeah, they wanted to replace their construction lender. They weren't particularly proceed sensitive, but they wanted a little more than a bank was going to give, because the bank was going to look at it as like a rental, which is not.
Got it.
Right, obviously. I mean, what's obvious to us is not as obvious to a lot of people for some reason. But
Okay.
so it's not quite bank debt, but it's also not really a construction or bridge loan or heavy rehab, right? So it sort of fits into that little space.
Got it.
So that's what we would
Would you
consider.
consider those your more secure?
Much more secure. The coupon, the rate we're going to charge is going to be less because the risk profile is less.
It's just ways of diversification throughout the capital stack.
Yeah, and like, one of our, like as I mentioned, we manage money for like insurance companies and pension funds and what have you. And like, there's an appetite for that, right? They're earning a premium to what the bank would typically earn, right? Maybe 100 basis points, 150 basis points, but it's a much lower risk profile than something that has a little more complexity to it.
All right, so rates have been going up, right? The Fed has been raising interest rates. Treasuries are up. You mentioned that your rates are up. You said 12 to 15%. I saw on your website it said 7 to 12%. So how do you figure out like what rates you're going to charge?
Sure. So we price off of prime, right?
Okay.
The Wall Street Journal prime rate. So it depends on that risk profile. So
Got it.
The core plus stuff today, used to price, when we did the 100 Franklin loan as an example, or just in the spring generally, that was mid single digits. What was mid single digits is probably now, 8% or so, right? It's just because prime has moved.
Yeah.
That. The stuff that was pricing, 7 to 9% is probably now 9 to 11 or 9 to 12. So
Yeah.
we price off of prime.
Got it.
And it's really, again, to the comment of sort of sitting in the intersection of real estate and investment management, if you're on the investment management side and you're looking at, wait, I can buy treasuries and earn 4%, right? Or I could buy, Citibank AAAs and earn 7 or 8%. Like, you're looking at that math, and then you're saying, well, like, I'm not going to lend on real estate illiquid in New York and make 5% when I could buy, treasury bonds and almost earn the same amount, right? So
Yeah.
you're sort of weighing the pros and cons. But we price off of prime, and the different products have different risk, points, and so they move up as you move up the risk spectrum. The pricing increases, but
Yeah.
the base is prime, so everything moves for us off of prime.
Got it.
Other some banks and lenders are SOFR or Maribor. Everyone
Yeah.
has their own.
Okay.
You brought up these other markets. Like, I know the Hamptons, like, not as well as you, but relatively well. Like, I go a bunch of times a year. If I was doing a house out there, and one day I hope to,
Yeah.
who do you call for this kind of financing, like this construction financing? In the city, you have people, but like, who knows the Hamptons well enough to say, okay, on that street, in that part of the street, in that area, I feel good.
One thing I'll
have it.
add real quick before Seth talks about this. I was out there not too long ago. I think it was I was staying in Amagansett, but I was in East Hampton, and I saw your signs all over the place. Like,
Yeah, we're the largest private lender in the
like lending provided by Urban Standard Capital, like signs in the front yards.
I just put them in people's.
Nice, yeah.
Get off my yard.
But it's well branded.
But who would you call? Like, obviously, I know Seth, so like that's easy for
You
me.
don't have to call anyone else. You just call me. That's
no,
the
yeah,
whole
for
point.
sure. But like, that's who else knows? Like, is there a localized lender that does this type of work, like the construction lending? I mean, it's serious.
Banks hate the spec lending business. Borrowing, if you're borrowing for your own home, that's a little easier. It's not easy, but there are banks that do it, right? But in terms of there aren't a lot of commercial purpose banks, and if there were, there are even fewer today.
Like in Connecticut, Fairfield County, there's a Fairfield County Bank, right? Which is
Yeah.
a community bank. They were like my father-in-law's in the business a little bit. They were definitely doing some spec and some condo spec, and they were there. But I went to their holiday party, and they were like, they're in the ground. Like
Yeah.
they're not even talking about lending. So like, what do you do then?
And well, you call me.
Yeah,
right?
exactly.
And that's the truth of the matter. And
Yeah.
even before this current situation, which hopefully is not a normalized situation, but the reality is there are lenders in the Hamptons that are they're not Hamptons. There was a bank, but they're like more regional balance sheet lenders that would do spec. The challenge. And we still see them. That's probably our biggest competition. We don't really see a lot of other private lenders out there. We also focus on like real builders and developers, not my wife and I have a Pinterest board and we've always wanted to like build a house in the Hamptons. Like we don't do that. But it's really a question of why what somebody's looking for. So if you're a developer and you have a term sheet from conventional bank, typically what you're seeing is 60% loan to cost. Maybe less now. Most of those banks have a depository requirement of every bit of 10% of the loan amount. So all of a sudden 60 is 50 that you're actually getting. They take, bank loans are 90, 120 days, full recourse. The process for requisitions and funding deposits is laborious and, it not only is guaranteed. Depending on the lender, you might have a situation where, okay, your window package on this house is $250,000. You've got to put it, until it's installed on site. We're not advancing any funds against that, against that purchase. The problem is you're out of pocket now $250,000 for 9 months while you wait for the windows to be manufactured and installed, right? This is not going to Home Depot and buying off-the-shelf windows. So we will stuff like that. We'll fund deposits. We'll do a true 65, 70% loan to cost loan. So you're actually getting the proceeds you think you're getting. The requisition process is much easier because we're on the other side of the business. Generally, our philosophy is we want to help you get to the finish line of getting the house built. Having a house framed without windows, for example, is not really helpful to me or to the project. So we have a lot more flexibility for our borrowers, which they appreciate. And in some respects, we're almost like soft equity, right? Because if if that bank lender is only willing to do 50% loan to cost, once you factor in the depository relationship and blah, 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 now you've got to fund 50% as equity, right? Which means if you're bringing in LPs, you're diluting your profit share, right? There's a pref rate typically on that LP money. So each person sort of has to figure out what their comfort zone is. But it's allowed us, I think we've got 14 or 15 projects in the Hamptons alone right now, and it's been a great business.
Yeah, it's an interesting point with the windows. I mean, I've heard banks for these construction loans, they want to see the money in an account. Like, I'll give you $2 million, but I want to see that you and your partner have $2 million and put it in an account.
Yes.
So it's like, what's the point? Now you're constricting my money. What's the point of this loan?
Yeah, we just had a situation where a bank was like, oh yeah, we can go from $4.5 million to $6.5 million with a $2 million depository relationship. I'm like, so you're going to agree to lend the person back their own money at 6% to go over? I'm like, this is like, I'm like, I thought I was being punked.
Yeah. No,
but
I've heard it.
And that's we'll often say to borrowers, we'll look at the term sheets, right? Because we know what, where the sort of I got you are, right? And we'll sometimes we're not the right fit. Maybe you find somebody who, for whatever reason, gives you pricing that's out of market, and we're big boys, that happens, right? Fine. I'm sure you guys have occasionally, I'm sure you have the buyer who comes out of nowhere but performs.
Sure. Yeah.
And you're like, it's a risk, but maybe that risk pays off. So we do have those conversations. But generally, we're certainly the most consistent, and what you're going to get, and we don't have those kind of things. We're really lending on the real estate. We're not holding your deposits or whatever it is.
Yeah.
So when you're doing these big loans out in the Hamptons, I think you're doing stuff in, definitely in the tens of millions, potentially 20s and up.
Most of the 20s and up stuff is Florida.
Okay. It's Florida.
Yeah.
All right, but you're doing these large, what is this, high-end spec house, housing lending, and you're the credit committee for these.
We talk about them.
So how do you get, it's just a high price point, right? On the housing markets, how do you get comfortable with these types of this type of loan profile?
Yeah. So we really, we bet on the horse and we bet on the jockey, right? So we're really making sure the real estate makes sense, and we're really making sure the sponsorship execution is there.
Got it.
The groups we work with are top builders in the Hamptons, right? This is not their first project, right? They know how to build a quality home. A lot of them are, have businesses that's a mix of custom and spec. So the end product is really important to us that we're financing, because one, we want we want to be part of something that, we have pride in being associated with. We want our borrowers to have that pride, but also from a defensive position, like we're seeing now, where there's a little bit of a slowdown just generally, the stuff that's well designed, well executed is moving. And we just had 2 houses in Sag Harbor go into contract at ask, and they're one's 4 and the other 6 months away from completion.
Wow. I believe it completely.
There's just there's always seems to be an industry that is doing well, right? And maybe it's not like crypto at the moment, but and there's just money. And so in a market like Palm Beach or Miami or Vail or Beaver Creek or Aspen or wherever, the Hamptons, if you have that good location and that quality product, you're in a pretty good spot. And if we're lending 65, 70%, 75% loan to cost, the developer typically has a 25 to 30% margin, right?
Yeah.
So we're effectively 50% loan to value, right? And we have a pretty substantial cushion before we're at risk at all. And again, between the sponsorship, we only make loans where we think the borrower is going to be successful. I'm not interested in getting, stuck or sucked into somebody's, project. It's I'm going to put up a $20 million house in an area where there's never been a house more than $10 million. We see those kind of inbound inquiries, or I've never built a house. No, thank you. That's just, not.
So you bring this up. Obviously, we get your business plan. Is there, not to go into details, or like what's like a bad situation for you, like that you've maybe found yourself in, like with lending? Because usually, like Steve and I talk about it all the time. Like we don't really see, like if you do it the right way and you're lending correctly, where's the risk? I mean, obviously there is risk. There's inherent risk, but we don't really hear about these stories where it goes bad for the lender.
I think I think there's some skill to it, but there's also, like, frankly, some luck. Like, we focus, 70% of our book is residential in nature. So for rent, for sale, multifamily, mixed use, single family. Mm-hmm. As an asset class, residential has, along with industrial, have just crushed it, right? I mean, there was early innings of COVID was a little tough, but like have performed well. If you look at the lenders on office and hotel, I mean, it's a bloodbath. Right, and so they're taking key. Blackstone just gave up the keys on an office building in Midtown, right? So like it happens, but again, if you're lending on something and you're doing it in a disciplined way, 60, 65%, 70%, you have a pretty substantial margin of safety for values to drop before your capital is at risk. It's not impossible, right? I mean, our average LTV in our book is about 60%. So we're very focused on, downside protection and margin of safety. I mean, my investor base is in the stay rich game, or like pay out to the pensioners their money. Yeah. Like they're not in the business of like buying, high risk assets. And I'm not in the business of doing that for them, right? So, but, I think if you have an underlying asset type that gets impacted, it could be a problem. Regulatory risk. I mean, you've seen what happened in 2019. Yeah. I mean, smart guys in our space. If the rules get changed and you're in the middle of the game or your investment, like that's not because any of these guys who are now in default, who we all know, it's not because they're not smart guys. They just,
it's bullshit. They got caught. Really, you can't change the rules of the game. That's the problem.
Yeah, exactly. So but that can happen, right? And now you look at major banks who have books full of that, and they have problems. So that's where it can go sideways. And our goal though is like in that kind of situation, like if you have, if you have sort of an unexpected twist in your business plan, is sitting down with our borrower and saying, okay, like how do we land the plane, without killing everybody on board?
Yeah.
Right. Like you're not guaranteed to make money in this business. Some investments are going to be better than others over the course of somebody's career. But how do you do this in a way that's like the least painful?
Have you ever had to foreclose or take back the keys or anything like that?
We have, actually, not far from where you live. I don't know how many loans we've done. And that's sort of a good example.
Can we talk about that? Like what happened there?
High level.
High level.
Just out of respect for the person.
No, 100%. But like just checking on Acris before the call, it seemed like there was a high loan there. Like maybe too high of an LTV.
I think, what was recorded though was also a construction loan that was much higher than an actual loan. Right. Okay. So when we, if we're lending, you might see a loan for $10 million recorded on a property that's being renovated and repositioned or financed. Yeah, it's not like that money is only released as you're making progress.
For sure.
So it's not necessarily the same. But I still think it's a relevant example. The borrower, repeat client of ours, phenomenal person.
Yeah.
That property, even though it's an incredible location, corner of Main and Main, right? They, it has a significant retail component, right? And the retail market shifted pretty significantly with COVID.
Yeah.
So, I think the economics for that person, started to not make sense, right? Because the retail market changed. I think the appetite from investors maybe was a little different to like put in additional funds, like we're going to start to see now. Some people are not going to pony up. Either they don't have the liquidity, they don't have the confidence in the market or the asset type. That's an incredible asset, right?
Oh, yeah.
And and it's not to say if some lender forecloses or takes a property back. Like in that case, we did a deed in lieu.
Okay.
Right. So what that just means is, when you start a foreclosure process, you can agree with the borrower to say, all right, I'll let you off whatever guarantees or deficiencies, and you give me the title. Right. That was the case there. We have, that particular borrower, again, we had done several deals with, I lent to him again.
Yeah.
and there are things that can be outside of your control, and I think that was the case for him. But it doesn't mean that you're necessarily going to lose money, right? Because your basis is not their basis, right?
For you as the lender.
For me as the lender.
Yeah.
So
Right.
like not to like kick salt in the wound, but like that was a good deal for you to take it at that price.
We still own it, so I don't
Yeah.
know, right? But like, it's certainly, not necessarily like so bad.
Yeah.
One of the nice things, I guess, about our platform is we can develop it.
Yeah.
Right. And so, we always like to have multiple options. Like I'm a big believer in optionality and maintaining different, paths to exit or paths to profitability and not being locked into one scenario. Like maybe we'll develop it, or we're going to sell it.
Yeah, I've seen you buy all over the spectrum too. Like I remember, I think it was on Court Street, it was a corner piece that I thought you got a great deal on, but I was surprised to see you as the buyer there because usually we're doing deals with you that were like multifamily deals. This was like a pretty retail centric deal. So, I mean, it's interesting to see. I mean, there's a lot of stuff. I mean, Derek will bring it up too. The stuff in Manhattan that you're doing. These are
Well-
deals that I wouldn't see you doing.
Yeah.
So
Yeah.
I guess to take a step back,
Yeah.
and just when I was doing research
Yeah.
before the conversation, his website says they're a lender, developer, and they have an investment firm.
Yep.
In my head, like we just spoke a lot about the lending, development we can talk about, but he's done ground up, he's done alt ones, he's done alt twos, townhouse conversions.
Rent stabilized, straight rent
Well, and
stabilized
then
deals.
in my head, the investment firm, and I could be mistaken when I look at it like this, but I'm like, okay, well, he's also buying multifamily, rent stabilized, free market, mixed use, retail, tax class 2, tax class 2B, tax class 4, land, obviously. I just saw a building that he bought, looked like it was a taxpayer retail property. It turns out it's part of a larger development site. But
Building homes in the Hamptons,
you're building homes in the Hamptons?
right? Or
No, in the Hamptons we just lend.
except for that, I mean, I saw your house. It's amazing in Watermill.
How did you see that?
I mean, it was publicized and it was out there. You had an article written about it.
Yeah.
It's nice. I mean,
Thank
it's a
you.
beautiful house.
But that's my house.
But did you build it
I
yourself?
did. Yeah.
Oh, you
good.
built your own house?
I mean, I wasn't swinging hammers, but
Yeah. Yeah.
if I was, the house would not be standing right now.
Yeah.
Got to know your limitations.
Yeah.
And so the new buildings, the grounds up in Manhattan, you're not swinging the hammers on that stuff.
No, thank
Yeah.
God. For the future residents.
It's incredible.
But like,
talk about the
but-
development for a minute.
Yeah, so like, I mean, I started on the equity side of the business, right? In 2008, I bought my first multifamily class tax 2B building in West Chelsea,
Okay.
and I probably done 35, 40 development projects, and they range from stuff like repositioning and of single family and multifamily and mixed use assets to ground up development. And as I mentioned, Urban Standard sits at the intersection of real estate and investment management. We have demand from our investor base for sort of the credit debt product, right? Lower risk profile, yield oriented, income oriented. We also have demand for equity exposure, right? And equity exposure could be ground up development, for sale condo. It could be rentals, and so we do have vehicles that are active on the equity side too. So we do both, and part of doing both gives us, I think, they're very complementary, right? Understanding, again, the intersection of the capital markets and the investment markets and for real estate. But when we're talking with borrowers, they're sitting across the table from somebody who's done generally what they do before, right? Whether it's me or one of the members of our team, and I think that helps us not only deliver like the speed and certainty of execution, but be really like thoughtful and creative about deal structuring, right? Because these deals do morph over time, and being able to sit across the table from somebody and say, all right, like we have an opportunity here. Like we didn't expect to be able to get the adjacent building, and now we can assemble it, and like now it's worth more value. Will you upsize our loan so we can buy the neighbor? Like there's a lot of back and forth that we do regularly. And I think if we didn't have, and our team didn't have the equity experience, it'd be a lot harder to do that and to be so nimble.
So like you bought like these rent stabilized buildings recently, call it like at a 5 cap. Meanwhile, you're lending out money for over 10% returns. So why would you buy a rent stabilized building? I mean, I guess you touched on it with just equity exposure.
Yeah. So I mean, lending out money. There's a couple reasons. So one, only recently have the rates moved to be, north of 7 and 8, right? So I think the comparison more is probably, 5-6 cap rates versus 7-8% loans.
Okay.
Two things, or one very important thing to keep in mind is the tax treatment is very different. So if you're an investor receiving that coupon of 8% or 9 or 10%, it's ordinary income.
Got it.
Right? If you are, receiving dividend income, it's dividend income, and you have a depreciation, shelter. On top of that, something all investors should be doing is using accelerated depreciation for their LPs, because what that does is it allows you to pass on a, non-cash loss to your LP upfront, right, which reduces their effective, cash position immediately, right? So like I just invested in a friend's RV park business, and I think I got back a third of my investment in the first year just as a tax loss.
Yeah.
Yeah.
Right.
It's amazing.
So for me, I'm like, I invested X, but I really am like got 2/3 X in it because I picked up a real tax benefit. So I think there are tax implications to the two strategies that are important to be aware of.
Cool.
And the other thing is, and this is starting to go away a little bit, is are there opportunities to to drive value, right? So without naming like the specific buildings for a variety of reasons, we'll go in and we'll say, all right, it's a 5 cap, but it's a 5 cap based on an oil bill that's 3x what it needs to be if they just converted to gas and spent the 50 or 60 grand that like I can write that check, but if you're a long-term owner, you probably can't write that check, right? And you certainly don't have access to the capital markets to go borrow 50, 60,000. So all of a sudden my bill goes from $15,000, $16,000, $17,000, a year to 5, right? That's a real value creation, right? Similarly, renovating apartments, I don't know if they're going to get rid of this, but the ability to set first rents. There are a lot of things where you can build to a, maybe you're buying at a 5, but you build to a 6.5 or 7, and then you lock in, cheaper financing, and it's tax efficient. So that's really like where that, why we did those kind of things, and they've been very successful.
Great.
Now it's a smaller scale,
Yeah.
right? But like it's a nice sort of, business, and again, we understand on the lending side are people who are trying to do that. I think now is actually a really interesting time to be doing it because if you can buy, we saw over the last couple of years, people were buying at 4 caps with, I'll say, questionable expenses, and they were going to build to a 5 and sell to Carlisle, and well, all of a sudden, like the market's really moved because again, if you can buy treasuries and earn 4, like everyone's sort of return expectations have gone up, but I like that you can buy well-located assets. If it's a real 6 or a real 6.5, and maybe there is some upside, and it could be maybe it's not just rents, maybe it's stuff like like the oil to gas conversion or doing stuff, delayed CapEx that will limit your operating expenses. And you have the benefit of if, rates normalize and cap rates compress, you don't have to go back to where they were, but they compress and you've built to a 7 and they normalize at a 5, it's good to have that in your back pocket, right? Like you're coming in today's market with that dynamic. You're coming in with like, everyone has the worst expectation for the rent regulated situation. I don't know if they're going to change it. Like to think it's not going to get worse. It's hard to know, like, short of like just taking the buildings from you, how it gets worse. But like any positive momentum on those two fronts accrues to your benefit. Whereas people who were buying 4 caps with fake expenses, were blown out by cap rate expansion, were blown out by the tenant law changes. I don't like that dynamic. I like the dynamic where you can clip a nice in-place coupon and you can have some things break your way that really push returns. I mean, a lot of stuff I bought 2008 to 2012, 2013, that did phenomenally well, right? And why did it do well? Like we bought it in a time when they weren't, 3 caps or 4 caps or whatever it was.
Yeah.
So.
Real quick, and I don't want to ask too many more questions if we're getting tired. We could try to wrap soon. But real quick, on the accelerated depreciation stuff, like we've talked about this in the office, and like you're bringing down your basis, and then you have these LP investors. You go to exit through a sale, and all of a sudden they're just paying more in taxes, right? So any thoughts?
Yeah, for sure, right? I mean, you're bringing your basis down.
Yeah.
I think it depends a little bit on what your hold period is, what your expectation is. I mean, I think in like, my immediate benefit as somebody who just made this investment is, okay, my tax bill in this year, I got that. I saw the benefit of those dollars today.
sure.
In 5 years, if I have to pay a recapture, and I'm paying it, I think the tax rate's also a little bit different.
It is.
Right?
Yeah.
Like, okay, fine, I'll pay in 5 years.
Yeah.
But at my ordinary income tax rate in New York City, like, I will take those dollars today.
For sure.
I'm with him on that.
Yeah.
100%.
It's
I don't
opportunity
see a
cost. You get
downside.
the money day one.
Of course. I mean, if I didn't have that loss, I would have had to write that check. Yeah.
And you can't put a value on what are you doing? Like, let's say you save 300 or 200 grand in tax money. Like, what are you doing with that 200 grand? How much are you growing it that year?
Exactly.
And you're young, like it's gonna grow.
So young.
Pay the tax
Yeah.
later. Who cares?
Right. You sort of
That's-
like there's a benefit to tax deferral, right? And
100%.
so, and I think like some of the best investors and operators think like what's best for my LP, right? And how do I, reward them? It's nice to have a win out of the gate, right? And it sort of lowers the bar for everything else because now you've taken some real money off the table. You let the business plan unfold, but you've picked up that benefit.
100%.
So
Yeah. Cool. Who's the company that's buying all those apartment buildings in like the Midwest? You wanted to invest with them. I forget what
No. Remember Financial Samurai?
Yeah, Financial Samurai
Now
talks
he's
about it.
throwing them
Yeah, he's like,
He's
no,
I
man.
wanna do it.
You wanted to invest with them, and you wanted to go tour all the assets.
Yeah.
You wanted to go invest in
No,
Kansas City.
when you got me onto like Financial Samurai, I remember, and I think he's like off this shit now. He doesn't
No,
talk
he's
about
into
it.
it.
Still,
He's very into it.
It's
Investing
share
in real estate.
something.
I forget what it's called.
I don't like.
There
the
was like
idea.
fun. I don't know if it still exists. There was like Fundrise, Realty Mogul. There's
Realty Mogul.
Cadre.
It's Realty
Cadre,
Mogul.
yeah.
It's Realty Mogul. Yes, it is.
But yeah, there's these platforms. It's interesting. I didn't think about all the unintended consequences of like just raising these small stakes of money, and then these people take it very seriously, and they want to have like, you spend a whole day with them touring the assets.
As they do. I mean, listen,
Yeah.
I have to think about my fee stream from talking to somebody who is investing 25, 50 grand. I'm losing money in that conversation all day.
Yeah.
Right. And I just, it's not how I really want to be spending my time.
My last question here. We've been talking for a while. We appreciate the time. I know you were working on this Real Estate Has Your Back for a while there.
Yeah.
Is that still going on?
We just did it during COVID.
Okay.
It was very successful. I mean, I think I want to say delivered like 10 or 15,000 meals.
It's amazing.
And it was great to see we had, 50 plus participants from the real estate community, really rally to do it. We'd love to do more stuff like that. I think like the real estate industry really gets a bad rap, in New York in particular. So I think the more stuff we can do to sort of shift that narrative, the better.
Yeah.
Yeah, we need to shift that narrative because it's almost like it's a lot of it's made up, obviously, but it's like it's such a detriment to the business. There's like everyone's just trying to like.
Yeah, it is rhetoric.
Yeah.
I think there's starting to be a shift a little bit as people recognize like there's a tremendous need for housing. I mean, you guys know a lot of operators and developers as I do. I don't know anybody who wouldn't build affordable housing if it made financial sense. Right? People just want to do something they're passionate about, but something that is profitable. And when they change the math, whether it's the rent regulated stuff or 421A, and they make it unprofitable, and if you're an outside investor and you're saying, I could go anywhere, I can go to Florida, I can go to Texas, I can go to Alabama, right? Like, capital doesn't need to come here, right? And I think, like, unfortunately, certain elected officials in New York took the opposite view of, fine, don't come here. Well, we're seeing what happens now when they don't come here, right? Or when those taxpayers leave. And it's to the detriment of the city. It's to the detriment of affordable housing. And it's shameful because I think by making a couple changes, they could very easily sort of switch it, right? And you would see it with 421A where, the sort of narrative from the far left was, this is, the developers are getting, this X billions of dollars a year that should be going to pay the taxes. And I'm like, very simply, those buildings would not have been built if that tax abatement wasn't there.
Now they're not being built.
And now they're not being built. So to say like, oh, the taxes should be this, it would be zero, right? And you don't have to have gone to Wharton or Harvard to understand that, right? But I think unfortunately that rhetoric and that narrative really, has been promoted, and it's to the detriment of the city. So.
And they belittle the management. I mean, the owners are managing the housing of New York, and it's a really hard job. And the city pretends they don't know that, but they're awful managers.
Okay.
Their housing is like falling apart.
Well, right. Like that's the thing. Is you want to live in a NYCHA complex,
Yeah,
right?
no.
I mean, like I think that's on the public advocates. Running for the last couple of years has been the worst landlord, and part of it is you need real money to maintain these buildings and maintain quality of life and safety and cleanliness, and to pretend otherwise is just disingenuous. And I think that unfortunately there's a real consequence to that. I also think, and I think the mayor's done a really good job of at least saying the right things and saying what's obvious. I mean, I think I saw a clip the other day of him talking about, the tax base in New York, and I was at a breakfast with him just before he was elected, and somebody was criticizing him for, being, enamored with the rich, right? And he's like, it's not that I love the rich. He's like, the top 2% of New Yorkers pay 52 whatever the percentage was of the taxes.
I saw that.
yeah,
I think he told that person that they can leave because they were like, let him leave.
you leave with
100%.
your like negative, tax paying whatever.
For
so
sure.
like, and the fact that he will say that, when we came from an administration that either didn't understand that or wasn't willing to say it for political reasons, at least is a step in the right direction. Now he doesn't have the full controls that the governor and the state legislature do, but I think it's important to recognize that, because I know like how I feel with real estate has your back and just being part of the overall like ecosystem here. It's heartbreaking to see people be living on the streets and living in the conditions and what's going on crime wise, right? And you'd love to be part of the solution. On the other hand, when you see, I got into this sort of discussion with an elected official. I was like, you go sign on a 8-figure personal guarantee on a construction loan to earn no money, to earn a 5% return. Like, you can't attract the capital markets to support that endeavor, because they're just going to go to another market where they can earn a market return, right? Like, and if you don't get that, we're going to be stuck, and that's where we are today, right? You're just not seeing the construction or rehab of housing at the level that it needs to be.
I saw something today. A client of mine sent it, but I guess Kathy Holschel's going to try to sign in. It would rent stabilize units as long as you put a program in Section 8 or any other programs that you could even go above the legal rent. So they're basically incentivizing not leave these units vacant, put Section 8 and charge whatever you want. So that's a step in the right direction.
Yeah, because there's a recognition. I mean, I've heard different numbers. Is it 60,000 units or 40,000 or 50,000 units that are vacant? There's only 60,000 homeless people. You can put a real dent out of the gate. I can't speak for everybody, but if you said, if you house whether Section 8 or it's people who need transitionary housing, and you can charge them a market rent or even half, whatever it is, there's going to be huge demand. You could put an immediate dent into that.
They're saying you charge whatever you want.
Yeah,
pretty much a market.
Which makes a lot of sense, right?
Well, I think it's limited at the Section 8
Whatever they
rent,
vouch
yeah,
for.
but they won't limit it by the legal regulated rent.
Correct.
Yeah.
But that's a game changer.
But that's
It
a game
really is,
changer.
yeah.
Yeah.
Right. And so my comment earlier about like it's an interesting time to be buying some of these assets that have been plagued by this stuff, because not only could you, first of all, you're buying at a real yield in place. You earn 6-7%, tax protected or tax sheltered. That's not terrible, right? One. And then you have the upside of whatever you can do at the asset level, potential cap rate compression in the future if rates normalize, potential changes. I mean, that's a huge, huge win for the city, for the owners, for the tax base, right? I mean, if typically, basically property owners are the tax collection agency for the city, right? And, if typical owners, outside of 2B stuff, is paying 20-25% of their rent roll as taxes, all those vacant units, think about the tax loss.
For sure.
So it's encouraging that those conversations are happening, and I think there's more of a willingness to listen to them. So,
For sure.
Yeah. Anything else that you think we missed or that you'd like to go over?
No, I think we covered a lot.
Yeah.
I think what you guys do is great. I mean, I remember when I got started, like the critical part was, establishing like true relationships and partnerships with, brokers like you guys who know the market really well, right? And you can sit down and talk and say like, this is what I'm trying to buy, right? Like be honest with it, because I'm sure, for you guys in each of your, respective markets, there's the stuff that's listed, there's the groups probably would sell, maybe certain groups who are opening to seller financing, right, or partial seller financing. I mean, a lot of stuff I bought early was a lot of those kind of conversations of working with brokers, in a true partnership capacity to tell them, especially in the beginning when I was syndicating, it was like, this is my limitation, right?
Yeah, sure.
But this is my box, and like trying to work together, and like I think that's you guys do a great job of sort of of owning the market for the types of assets you guys focus on, and I think people should look at it that way.
We appreciate that.
Yeah,
No,
definitely
totally.
appreciate
Thanks
it.
so much for coming in.
Thanks
for
for-
using your time.
Yeah.
It's
Thanks for having me.
Yeah, I think
Hopefully some of these terms made a little more sense.
that was a really helpful and interesting conversation. I think people are going to take a ton of value out of hearing your perspective on just all the pieces of the puzzle in terms of these real estate deals and how you look at it.
And no, I as I mentioned to you when we spoke earlier, like I used to be a real estate finance TA in college. So I was like trying to go back to the back to those days of like explaining things, hopefully in a way that made a little bit of sense. But we, just myself and my team, like we regularly, are sitting down with clients and just talking through, whether it's brokers and borrowers directly, like what challenges are they facing, and then trying back into like how can we solve them, right? Like, maybe it's a situation where I can raise half the money from my LPs, but the other half has a gap, or like there's a lot of dialogue and conversation to be had. So it's something we're always open to. So if you guys on your team here, or with you guys and clients want to have those conversations, we're certainly open to it.
Yeah, 100%. We'll definitely keep that in mind and encourage people to reach out for their financing needs.
All right, well, I appreciate it.
Yeah.
Thanks for having me. You have a
Yeah,
beautiful
100%.
office.
Thanks so much.
Thank you very much.
All right, guys, that's it. Seth Weissman, Urban Standard Capital.